Hello and welcome to this special CNBC Africa debate. I'm Nozi Pombanjwa. Now, with a population of over 1 billion, a rising middle class and a vast array of mineral resources, the African continent seems to have a bright future. However, issues such as poverty, lack of access to education and a severe infrastructure deficit still remain as significant challenges. That said, today we'll be taking a closer look on how we can unlock Africa's growth potential despite these impediments. And we'll be doing this by dissecting the potential impact of 3 economic pillars, including financial education, skills and infrastructure development. Joining me in studio to share their views are Mogam Pillay. He's the Chief Financial Officer for Africa at Old Mutual. Fungai Tarirah, he's the Chief Investment Officer at Rudiarius Capital Management. Richard Matchett, a Divisional Director at WSP, Civil and Structural Engineers Africa. And joining us from our bureau in Lagos is Bismarck Rewane. He is the CEO of Financial Derivatives Company. Gentlemen, welcome and thank you for making the time to join us. Mogam, let's start off with you just painting for us the relationship between financial inclusion and inequality as we tackle the first pillar, that being of financial education.
Thank you, Nozipo, and it's really a great pleasure to be on the show and to share with you some of the experiences that we encounter on the continent. So I think in terms of financial inclusion, if you think about Africa's population and the billion population that we have in Africa, that's projected to be doubled over the next, call it 15 to 20 years. We know that at least 80% of that population is unbanked. So they do not have access to formal financial education, formal financial training, and that creates basically a big opportunity for financial services companies to enter the continent. And financial inclusion is important because that 80% of the population is largely sitting in the informal sector. And over time, given Africa's potential, the work that is happening around foreign direct investment in Africa, the growth in infrastructure development, that informal sector is likely to become more of a formal sector. We should have more and more of a growth in the middle class, and that would mean a bigger need for financial education on the continent.
It certainly sounds like there's a very strong case why we should move towards inclusion and away from exclusion. Let's go to Lagos and Bismarck, let's get a sense of whether we have a clear understanding of the structural barriers that continue to keep vast amounts of the African population locked out of financial services.
I think from our perspective, what we see in Nigeria is that Nigeria is about only 47% of the population are financially included, which means about 53% are financially excluded. Some of them voluntarily and some of them involuntarily. But really, for example, Nigeria has a trade as a percentage of total GDP is about almost 16% of the activities in the country. And the traders and the manufacturers find that going to the banks, right, and their understanding of transactions, going to the banks takes a lot of time, and the cost of transactions, not because of the financial cost of the transaction, but the time they spend going there and the time they spend waiting for the transaction to be consummated and the satisfaction they get makes it almost impossible. So they stay away from the banking system because it is too time consuming and it is too financially expensive. Thirdly, there's a question of financial literacy. So when you put all of this together, we think that if you remove the constraints and the barriers to financial inclusion, you will see a major spike in the velocity of circulation, the payment and settlement of trade transactions, and a spike in GDP.
Fungai, a very important point that Bismarck has raised there around financial literacy. We always see this in the political rhetoric. We see it in the policy documents, but is it actually happening on the ground? Are we finding that the private sector, in collaboration with governments, are actually taking financial literacy seriously and really trying to get the vast members of these financially excluded educated?
So there's been a number of initiatives, both led by public and private interests, to try and improve financial literacy in many of the different countries across the continent. one of the things you find is they are actually working on disaggregating the services that they actually sell or provide to the people who are trying to be included in the financial services. So if you look at things like mobile money, which has taken off quite a lot or at great pace in many countries across the continent, the biggest thing there has been separating that from some of the more complex transactions that one can actually carry out. So you might not be able to get a mortgage, for example, or get a credit card in some of the institutions, but it's now a lot easier using these various channels to actually make a deposit, make a withdrawal, and make a payment, whether it's to a business or to a relative across the country. So more and more of these initiatives are being growing. We all know the successes of payment systems like M-Pesa. Econet has come up with EcoCash. In Nigeria, you've got quite a number of systems that are all coming through in the system and allowing more and more people to be included in the basic level of financial transactions.
I want us to interrogate some of these strategies, and Mogam, I'm going to come to you with that question, but before I do, Richard, the classroom has always been put at the epicenter of financial literacy as well, where we're advocating this idea that the average African child now grows up being aware of the financial products and their financial responsibilities. Is this utopia? Or is this actually happening in the classroom? What's your sense of this, this sense of community around positioning this around the classroom?
Well, I'm not sure about what exactly goes on in the classroom, but what I will say is that the availability of these facilities to young people, they're growing up with cell phones in their hands. It's becoming more and more accessible, and I think they're watching their parents transact more than maybe previous generations, and I think that that awareness is helping the next generation that is rising up now be aware of using money, working in markets, moving money around. That's a good thing. As the children grow up realizing that money is a resource that they need to manage and be careful of, and I think that's a huge step towards a good future for Africa. And
of course, Morgan, just to come back to that issue, we've seen governments using microfinance as one of the policies to really drive financial inclusion and financial literacy. But there are naysayers, and the naysayers are saying this is enabling the exploitation of the poor, and this is not coming with the financial education that should be bundled with these services. How do you respond to that?
I think firstly, there's no doubt that microfinance plays a significant role in terms of developing economies and bringing, as I mentioned, small and medium enterprises from the informal sector into the formal sector. I think for organizations and financial services companies that operate on the continent, financial education and training, in my mind, has got to be a philosophy of how they operate on the continent. It's got to be the backbone and one of the key principles of how they look at customers, at how they understand the markets and what products they take to those markets. We in Old Mutual, as an example, we spend a lot of time understanding the consumer. And really understanding what the consumer's needs are, and then focus on, you know, how do we safely meet the needs of those consumers. In the microfinance area as well, it's generally businesses that are high risk. And I think that's why you would get a lot of naysayers in there, because it's generally high risk and high returns. And I think doing it in a way where you are socially empowering the people is very important.
Bismarck, let's maybe test the analogy that Mogam has shared with us. High risk, high return, and maybe have socially empowering the communities within which you operate. All of this does boil down to regulation. To what extent do you get a sense that regulatory bodies are ahead of the curve and they're ensuring that consumers are, one, educated, but also protected as they become more and more closely aligned to the financial services and products on offer?
In Nigeria, for example, the regulators are ahead of the curve. But you see, you have to delineate the role of a regulator and the role of a policymaker. What we find in Nigeria is that at this point in time, most of the consumers are not so much concerned about credit, but about convenience and efficiency. In other words, whenever you know, it took 21 days to clear a check, an up-country check in Nigeria about 4 or 5 years ago. So you make a payment in a check and you don't have access, the beneficiary doesn't have access to the money, neither do you have access to the money for 21 days. the items in transit in the system in Nigeria was almost equal to 20% of total payments. Now, by reducing the time for clearing a check, up-country check from 21 days all the way to 3 days, which it is now, we increased the velocity of circulation of transactions and the volume of transactions by as much as 800%. And that alone has reduced the credit requirement in the country, because people take credit either for inventory or for receivables. But if you get your money in time in a well-settled and efficient payment and settlement system, it reduces your credit requirement. Now, coming to the credit itself and protection of the consumer, one, from onerous pricing, and protection of the lender, two, from delinquent borrowers. What the regulators have done in Nigeria is to ensure that the KYC, the know your customer documentation, the fact that people cannot take off the credit bureaus, the level of integrity in the financial system has been increased. Yes, we're not there yet, but the regulators and the policymakers have moved ahead of that. They've passed the cashless policy system, which reduces the amount of cash you can carry. So basically, I think the regulators in Nigeria, for example, are far ahead of the consumers in terms of positioning the products for financial inclusion.
Fungai, top marks for Nigeria according to Bismarck on the front of the regulators, but there's a thin line between having access to credit and indebtedness, and we often find that that line becomes blurred very, very quickly in many, many markets. Your sense of this interplay between the regulators and the markets?
I think in quite a number of countries you have seen this proliferation of credit providers, and it's really about the regulators' proliferation of credit providers, and it's really about the regulators' proliferation of credit providers, and it's really about the regulators' proliferation of credit providers, and it's really about the regulators' proliferation of credit providers, and it's really about the regulators' proliferation of credit providers, and it's really about the regulators' proliferation of credit providers. Very decent policies that are actually in place to make sure that operators in those environments conduct themselves in a notable way, and you find that a lot of them target NPLs and also target the cost at which these services are advanced to the customers, to try and ensure that the sector itself maintains a very good level of health.
Before we move on from financial education, let's just tap into the technology aspect of this conversation, Mogam, because on the one hand, technology is enabling greater access and greater inclusion, but do you think it's been leveraged sufficiently to drive the education part of the equation?
I think, Nozipo, education has probably been the element that has lagged from a technology point of view. I think we've seen on the continent a lot of development from financial services companies like the likes of Safaricom with M-Pesa and other internet and mobile type applications that have gone to market with financial products. Most of those financial products are very thin, very light, and I think it will leapfrog the traditional distribution channels that we've had in the past. I think from an education point of view, there still is a massive opportunity to leverage internet-based education on the continent. I think it's largely an untapped market, and I believe that will transform when connectivity on the continent reaches new levels. So I believe it's a big opportunity. Well,
speaking about connectivity, I think it brings us to the question of infrastructure, and maybe let's jump right into that, because if we look at IT infrastructure and ICT infrastructure on the continent, it's perhaps one of the biggest pullbacks, Richard, when it comes to getting onto the innovation and the technology requirements that this continent needs. Do you get a sense just of an overall view, a bird's eye view, that from a policy point of view, enough is being done, and on the ground, enough incentives are being put in place for the private sector to step in and maybe really start investing in IT infrastructure?
There's a lot of evidence that the right things have been in place. If you look at how much technology is already on the ground, it's amazing the connectivity that Africa has at the moment. The number of undersea cables that link the continent, and then the degree with which the networks have already been put in place, the innovations in terms of cellular technology versus fixed line. to me, that is evidence that the right measures have been put in place to encourage the various different network providers to be there. So, to me, that's a big plus. I think that of all the different types of infrastructure in Africa, the cellular and the ICT is probably leading the way in terms of keeping up with the modern age. So that to me is encouraging.
Bismarck, let's get the Nigerian point of view in terms of infrastructure development. Richard's saying that he thinks that there's a positive headway, more could be done. But what has been the experience in Nigeria? In particular, if we look at economic infrastructure, do you get a sense that from a policy perspective that enough is being done at that tier as well as at an implementation level, that enough is being done to attract the private sector to come with their funds to plow into economic infrastructure?
Well, the infrastructure story in Nigeria is more of rhetoric than action. But having said that, if you take the telecom and ICT area, there's been significant investment and success. The GSM subscribers in Nigeria, over 100 million. The broadband penetration is growing rapidly. The personal computers and laptops per capita is one of the highest in the continent. So there's no question about the fact that the market has come to accept ICT development as a necessity, and it's driving business. But the only problem is that most of these things are driven by power. Nigeria has an appalling power situation, which is being addressed because of the privatization of power assets. But it's a long, long way to go. We're still talking about 4,000 megawatts, while our requirements are in excess of 25,000 megawatts in the country. So most of these technologies are driven by power, and as long as power is not adequate, then you cannot, the ICT infrastructure and the ICT equipment will not be reliable. But having said that, we've seen a significant improvement and in growth in productivity as a result of embracing ICT, the education and the technological aspect of it.
I want to stay with you, Bismarck, because I think you raised a very important point earlier on in that analysis. You spoke about how it's not translating from rhetoric to the ground. What are the bottlenecks? Why is it that this is the same situation in South Africa, where you have these pledges to infrastructure development and you have these big budgets allocated against infrastructure, but why is the pace of development so slow? What do you think is significant or particular to the Nigerian situation that accounts for the slow pace?
There's some disequilibrium in the Nigerian system, in the sense that these are oligopolies and that are controlled with barriers to entry. The bottlenecks at times are created to maintain the barriers to entry. But if you can dismantle those bottlenecks, which is what the country is trying to do now, you'll find that you'll see this quantum leap in productivity and gains. And I say this because the power situation was only debottlenecked after there was privatization. We haven't seen the results of that. The same thing happened in telecommunication. Now, the market and the global imperatives are pushing Nigeria to a point that you can no longer hold certain sectors back or protect them from competition and liberalization. If you do that, you do that to the detriment of the people, and everybody can see it. So it's only a question of time, and it's happening very rapidly, the change, which means that barriers to entry are being dismantled, liberalization is being embraced, and competition is being enhanced.
I'm going to be a little bit cheeky and put you in the firing line, Fungai. What I'm hearing from Bismarck is not much confidence in the power privatization process in Nigeria. I think he repeated twice that the fruits of that process are yet to be seen. And yet in South Africa, with the power shortages that we've been experiencing and the power crisis that this country is actually in, there's been lots of calls for the privatization of the power play. Should South Africa be considering the route that Nigeria has gone if Nigeria has failed to really deliver on that particular process?
I think if we look at a country like Kenya, which is further down the road as far as privatization of power production is concerned, you'll actually find that IPPs, independent power providers, have actually come to the party and done their part in terms of providing large, stable amounts of electricity to the grid, which has been of benefit to the rest of the nation. Prices are determined on a market-related sort of basis, and that allows for those businesses to be profitable, and it attracts capital to be invested in those particular areas of the economy. So I think if you were to if we were to try and speak into Nigeria's future, this is something that we are likely to expect. And as Bismarck has mentioned, we have seen the positive side of privatization come through with the mobile infrastructure. It wouldn't be surprising if the same thing actually takes place as far as electricity is concerned. So I think many countries, not just South Africa, should really be looking at ways to actually, or looking at exploring public-private partnerships to try and increase power production and power distribution in the areas that they look
Public-private partnerships, Richard, in the power space, the key tension point there will always boil down to the tariffs. The consumers want a lower tariffs, the investors want a return on their particular investment. Do you get a sense that we're hitting that balance right, enough to incentivize the investors and enough and low enough so that the consumer doesn't become increasingly under pressure?
There's another dimension to this, which is actually meeting the actual peak demand in the network. And as much as we look at base load, as much as we look at our big power stations to meet that, a lot of the opportunity that we have with the IPPs is to meet peak demand. And I think that it's a case of needs must. If we aren't able to generate alternative peak power sources, then one actually needs to look at a different trade-off, which is looking at bulk infrastructure with the major power providers versus trying to offset that with the IPPs.
The power situation, Mogam, before we move on from it, though staying within infrastructure, hearing earlier this week that the Minister of Energy in South Africa is saying that the power situation will stabilize by 2016. Surely that time frame is far too long. How much investment is likely to be lost in the interim? 24 months is far too long to have as a horizon before we reach stability.
Nosipo, that's an interesting challenge for South Africa, but I think what it does create is an opportunity for the rest of Africa. I think what you will find is that many foreign direct investors will move capital out of South Africa but into the rest of sub-Saharan Africa. So I think it's critical for South Africa to try and shorten that time horizon and to try and bridge the power gap, because you will find, and you'll be already starting to see, that foreign direct investment in the rest of Africa is growing at a faster rate than what it is growing in South Africa.
Bismarck, let's maybe get into the whole equation around capital and the funding of infrastructure projects on the continent. Just recently, at the recent G20 meeting, we heard of a new fund that has been established to advance infrastructure development. We know of the Africa 50 Fund and many others. From what it seems like to me, maybe it's the funding is not the issue, but it's the bankability of some of these infrastructure projects that seems to be in question. Which side of the fence would you take this on?
First of all, let me address something which was just discussed about 2016 being too far away to address the infrastructure gap, the power gap in South Africa. You see, the power demand is a function of so many other things. It's derived from the fact that is the economy at the bottom of the cycle, is it contracting, is it expanding, and all of that. It's no longer in your control. But what you need to do is to plan ahead of the requirements of the society. If not, you're going to be playing catch-up all the time. If you catch up at 2016, by the time you get to 2016, the demand has grown, and then there will always be a gap, and there will always be a failure. You can't afford to do that. So the policymakers have to have that clearly in mind, that you provide excess capacity so that the demand catches up with it, and then you are one step ahead. Secondly, having said that, now what is the most efficient way of funding infrastructure, which is the question: how do we fund it, how do we raise the capital for it, and how do we make sure that the funding is always there, even after you meet the initial requirements? I think it comes to the whole idea of how do you commercialize infrastructure, how do you extract value from infrastructure so that investors can get a return on it and will be motivated to continue to invest in infrastructure. The whole idea of leaving infrastructure be funded by government, which is what has been the African story, and to a large extent in Europe before now, has been what is responsible for the inadequate infrastructure story that we have. Look, in China, for example, in 10 years, they spent more than what they spent in the whole of the previous century. In Brazil, in 5 years, they spent over $780 billion. And that is what you need, those kind of audacious commitments to bring infrastructure to the place where it to be. Because infrastructure is about development, while growth is about short-term measurable data points. So, but you have physical and institutional infrastructure, which is the base on which growth will be, which will drive growth in the future. So we cannot be so constrained, and we cannot use the normal financial measures and structures to fund infrastructure. We just have to be audacious enough to know that infrastructure, we will always fund great excess capacity, and that capacity will be caught up, and that way society and the standard of living of the people will be guaranteed in the future.
Richard, let's get maybe a response to the suggestion that's being made by Bismarck that we need to be audacious and far more bold than we've been in the past. And maybe once you've done that, also take on the issue of how do we get institutional players like pension funds to begin to look at infrastructure as an attractive investment option?
Sure, that's a big one.
I think Fungai will help you on the second part.
Well, I must say, as I was listening to that comment, immediately when I start thinking about a massive injection of infrastructure investment and huge spend on that, I can't help thinking about skills, and I can't help thinking about capacity. And one of the challenges we have worldwide with engineering is the ability to respond to surges in development. We work out of a skills base that is developed over generations. As children are brought up in a school environment where they go through maths and science learning, they enter university, they graduate or college, and then they become trained, and then they become productive.
Yeah.
There's a time lag in that, and I think one of the things, in order to be able to respond to a need to play catch-up, is looking at the education behind that and seeing what capacity do we have. Recently talking to South African contractors, understanding that one of the key needs is to understand what the pipeline is going to be. The construction industry can only respond to a certain extent to surprises, and I think that's very important. So when it comes to the institutional side of things, having forward visibility is vital. When it comes to investing and seeing how a financial institution would see that as attractive to become involved, it's going to be about return, isn't it? And I think that's a challenge. We're seeing an endless debate with e-tolls. We're seeing the user pay principle being a challenge. So when it comes to concession, how do we do that so that it remains popular and so that we don't have challenges on that front?
There's risk versus return, and Mogam, I want you to take that on. But Fungai, when I mentioned the pension funds, I saw your eyes almost light up. Do you think that there is more that can be done to get pension funds to seriously start looking at infrastructure as an investment option, given that you have this beautiful alignment in terms of these long-term horizons?
So there's no question that the pool of money that's prepared to invest over the long term in these types of projects exists. The issue is now how to marry that with the opportunity where the infrastructure is actually needed. Typically, these types of investors would prefer to do it through a market-related mechanism. So that allows for market-related pricing, that allows for tradability of the assets. So in as much as a pension fund has got a 15, 20-year horizon, in year 6 or year 7, there might be a change in view. They want to be able to trade that asset and go on to something else that they're more interested in. And that speaks a lot into the development of capital markets and capital controls taking place in those countries. So as you mentioned, the fact that talent needs to be available, I think in the same way for talent, for funding to be able to flow across the different borders, it's really about getting policies that open up the different economies to allow that capital in, to allow that talent in, so that those audacious plans can actually see the light of day. So
a number of issues being parked with you now, Mogam, to take on. The first one being the risk versus reward. We know that a lot of these infrastructure projects are multi-country, and we know that that comes with its own risk because our regional integration mechanisms don't always work the way we want them to work. And also maybe just a quick response to Fungai's analysis here that says we actually need the depth in financial markets and other mechanisms to make these assets a little bit more tradable than they actually are at this point.
I think yes. I think you'll find that with pension funds, it's risk and has to be. Risk is probably the biggest element that needs to be managed, both in terms of flexibility, in terms of capital, but also in terms of return. I think for pension funds to invest more offshore, I mean outside of their own home countries, we have got to ensure that the climate for foreign direct investment and the climate for infrastructure development is a healthy climate. And what that means is that there are certain factors and certain success factors that we've got to build on. There's no doubt, given that the amount of infrastructure development that has happened over the last few years in Africa has actually been done on the back of countries actually upping their game in terms of some of the regulations. Countries have done really well in terms of governance of some of these projects, and that has led to some of the infrastructure momentum, if you want to call it now. But I think in terms of the hygiene of good infrastructure development, we need to see more depth in capital markets. And I think for a pension fund investing, it will need liquidity and it would need flexibility. And I think depth in capital markets will certainly help. I think in certain countries you need better liquidity management. To get funds and dividends and capital flowing between countries is very important. And I think investors build on that level of confidence. So the more of that they see, the more of that they want to invest in. I think the third element for me is about perception. Perception of corruption as an example. And we know that if you look at some of the countries on the African continent, there are perceptions of corruption on the continent. And generally, pension funds are responsible investors. And they want to put their money where they know it's going to be in a safe haven with decent returns. And I think those are some of the areas around climate that's quite important. I think there are macroeconomic factors like exchange rates, etc., that play into that. But I think if you look at exchange rates on the African continent, in most of the countries, they have been largely fairly stable over the last 3 to 5 years.
Bismarck, I think there's a couple of issues that you have to answer to. The first one is that I'm going to put Mogam's comment at you, the one about perception and corruption. Let's talk about to the extent to which Nigeria has been able to work on that brand perception in such a way that it becomes increasingly attractive, whether it's institutional investors or other investors who want to come into the country and plow their funds around infrastructure. The second issue that I'd like you to take on is what Richard raised about skills and capacity, and what the Nigerian example experience has been rather in terms of ensuring that there is a robust pipeline of human capital capacity to carry through on the visions that we've put on the table.
Corruption has become, Nigeria has been labeled as a corrupt country and all of that. I think in most cases unfairly, but deservedly as well, because there is high-profile cases of corruption, and the fact that we've not been able to tackle it head-on. But corruption is a function of disequilibrated markets. Once you have imperfect markets and there are barriers to entry, then that creates a rent environment. And rent itself, if you are going to be getting a reward that is not commensurate with your effort, then you are willing to pay something under the table to sustain that. But as we go along, you see, as we remove the subsidies in various areas of the market, as we begin to get various factors into equilibrium, the opportunity for rent and corruption begins to reduce. So if you take total amount of corruption as a percent of GDP over the years, it's been declining, but it is still monumental and it still has to be dealt with. But it's a question of the courage and the policies to ensure that you can actually minimize and reduce corruption. In the current world with social media and technology, no matter what happens, the corruption will always pop up and people will see it, and you can't get away with it in any case. Now, having said that, where is the human capital pipeline? In terms of investment in human capital, in terms of investment in ethics, in terms of investment in integrity, the Nigerian government and the Nigerian people have been investing significantly. But what we have not seen are the results of it to ensure that we can see an actual reduction in the amount of cases of fraud, cases of corruption, and cases of malpractice. But I can give you an example. The Security and Exchange Commission of Nigeria has had a zero tolerance for infractions, and you can see that the number of cases of capital market diversion, capital market fraud, and capital market infractions has reduced drastically, right? Yeah. The banking system, after Sanusi's intervention, has also seen a gross reduction in this. In certain areas, it's not as visible as you can say in some areas, but basically in the financial services industry, pension, for example, the pension area, there's been zero tolerance for infractions. The pension funds are now 5% of GDP from less than 0.5%, and they now have 5 trillion naira under management in the pension funds, and nobody has lost a dime ever since the Pension Act in the past 10, 11 years. So those are things that need to be acknowledged and need to be emulated by other areas where there is. In certain industries, there is still corruption, and that will be eliminated over time.
On that note of corruption needs both policy and courage to be taken on. A very big thank you to Bismarck Rewane, CEO of financial derivatives company, for joining us. We're going to take a short commercial break here in Johannesburg, but more on unlocking Africa's growth potential when we return with my guests in Johannesburg. Welcome back to the CNBC Africa special debate, where we're taking a closer look at the steps needed to unlock Africa's growth potential. And welcome back, gentlemen. Let's start on the issue of skills development, because I think the conversation was naturally going. Then, Fungai, let's get a sense whether, as the continent increasingly comes into the spotlight as the prime investment destination, whether governments are also flexing their muscles in the sense of ensuring that we've got the skills and the capacity to bring that investment to prosperity to the people.
Yeah, so I think a lot of the times policymakers get slated for not creating an environment as conducive as possible for skills to actually be developed on the continent. But I think we need to cut them some slack here. Because remember, when people are being selected for university or for artisanship or for skills training later on in life, the people who are selecting have to have a pool from which they actually get reasonably talented or reasonably educated people. Now, the statistics on that are staggering. The world, over the last 32 years, has been able to increase the average number of years that a person younger than 25 spends in school from 1.5 years to 4.5 years. That's on a worldwide basis, right? And in Africa, you'll find that the growth rate has actually been far faster than what has actually taken place on a global scale. Africa's year-on-year growth in the number of average years spent in school has actually gone up by about 2.7% each and every year for 32 years.
So we're spending more time in school, there's more access in terms of educational opportunity, but Richard, is this access translating into graduation and participation in the labor market? Because essentially, if the pipeline is growing in terms of volumes, we should be seeing a throughput in volume of the skills attained from the educational system. I don't think that picture always tallies.
Well, we're talking about infrastructure and we're talking about education, so I'm going to take some liberty and look at university intakes for civil engineering, for example. I'm a civil engineer. It doesn't seem to be increasing. If I look at graduation numbers over the last 15, 20 years, it's pretty much plateaued off, and that is surprising. The question begs asking, is there enough promotion of the industry? Is there enough attractiveness to become a civil engineer, which relates to, you know, what is it that the youth consider when they choose a career? And part of it is remuneration, part of it is what kind of a life will I be able to provide for my family. And I think that when one looks at any of those questions of enrollment, of whether children are moving from school into whichever career, it needs to be a global view on what the attractiveness is to them. I'm not sure if I'm answering the question there, but to me, we've got to speak to the children.
Mogam, you've got to be the referee now in this particular debate, because we've got Fungai saying that the numbers are getting better. We've got Richard saying, well, not in my industry. I'm seeing a plateau, if anything else. What has been your experience and your observation?
It's interesting. I think from where we are now, we know that there is a severe skills shortage on the continent. And it's not just in the financial services industry. It's across all sectors, industrials, engineering, etc. The challenge, I think, Nozipho, is it's all in the timing of when do you invest in skills development. And I think if you look at Africa's challenge, we have the youngest population in the world, but it's also the most unskilled population in the world. And if you look at the investment that's pouring into Africa, the amount of infrastructure development that we've been talking about, it's so significant. And unless Africa has the skills to support that infrastructure development, it's going to create gaps in infrastructure development itself. And I think it's important that governments, organizations, start looking 3 to 5 years ahead and start to ask themselves what skill is going to be needed 3 to 5 years ahead. Because to have that skill in place 3 to 5, 7 years out, you've got to start investing now. And you have to invest behind the curve to be able to get those levels of skills developed in the future.
Fungai, there's been an argument that the private sector could do more and that we could see more work placements and on-the-job training and upskilling and the likes. Do you feel that that movement has taken off, that the private sector has said, you know, I'm willing to take unskilled graduates and we're going to skill them up to make sure that not only are they able to produce the products and services that we're offering to the market, but we're building the human capital of the geography where we're operating in addition to that?
I think many people will readily attest to that chicken and egg situation where, you know, people are saying we'll employ you if you've got experience, but they won't employ you to give you the experience, and it just sort of keeps going around and around and leaves a lot of people without actually getting access to those jobs. It's really about the development of jobs within private sector. Private sector, I think, in many instances is incentivized to try and take on more of these people. But I think maybe if those incentives were better targeted, you could actually get more and more people coming through. You've seen some private sector participants take the initiative and sponsor school programs. You get a lot of companies across the continent who actually sponsor a lot of these programs, from bursaries right at university to building and running or paying for the running of primary schools.
Yes.
So right across the board to try and get more and more people into the system. But I think it's, you know, as Mogam mentioned earlier, the continent is particularly young, and that means that there are a staggering amount of people who still need to go through this particular process, and it's not something that I think one single approach will competently tackle.
Richard, we used to have a very robust bilateral program in South Africa where, I mean, take the example of Cuba and the healthcare skills that South Africans got through that particular exchange. I don't get a sense that that kind of robust interaction and foreign exchange still happens. Do you think this is maybe an option where we could look to other markets that have the skill that we require and maybe go aggressively with high volumes and high numbers and get that transfer of skills?
I have to confess that I'm not a fan of importing the skills.
And let's get your arguments for that. Why shouldn't you be importing the skills?
Okay, let's start with that argument. I think South Africa, I am an optimist. South Africa has some of the best skills in the world, and especially when it comes to technology. Historically, we have developed an amazing set of infrastructure. The challenge that we have is passing it on to the next generation. You can learn a lot at school. Universities teach you some of the basics. But really, when it comes to learning how to do the job, being exposed to the right type of work and being given the chance to make mistakes as a young person is essential in your career development. That means that there needs to be enough margin in the industry to allow the young people to go through the learning curves a number of times, to be able to mentor them properly. That's a margin beyond a break even, beyond the tight financial challenges that we have to try and make profit. You know, the private sector is profit driven. We have targets to meet. When it comes to the engineering sector, it is very competitive in terms of the winning of work. all of these things tend to drive prices down. When that happens, your margins get reduced, and one of the unfortunate consequences of that is it becomes harder and harder to train youngsters and to give them a real opportunity to go through the learning curve and to learn the right lessons. I think we're losing out at the moment.
What then about some of the policy measures? Take the youth wage subsidy. Is that an option where government says we will subsidize many of these unskilled graduates that you're taking on? Do you see this as a viable option, something that could potentially have really strong long-term benefits for a country like South Africa?
In certain sectors, I think it might be effective. In other sectors where we do find a lot of skill shortages, in the professional sector, for example, in the engineering sector, maybe not so viable. I think there, my suggestion is always to try and make a more lucrative environment where there is a conducive learning atmosphere. Otherwise, it's like you're taking away this side to try and give that side and compensate.
Yeah.
My preferred approach would be to open up the markets to discourage racing to the bottom on price, and rather promoting quality-based tendering, quality-based procurement, and also having measures that don't just ask people to make promises about who they're going to train, but actually say, show us how you've demonstrated your training and we will reward you with that, for that.
When we come back, I also wanted to touch on the FET colleges, because I thought that's what their job was supposed to be. But I want to tackle the issue of the organized labor, in particular looking at the union strength here in South Africa and how they've really managed to decelerate the whole movement towards a minimum wage for young people and the like. Do you think that the stronger the labor movement, the more difficult it becomes for private sector to actually get involved in the game and to actually begin upskilling young people?
I don't think so. I think, Nazipo, I think when it comes to unions, they play a role, and they play an important role in terms of ensuring that the levels of social development from an employment point of view takes place. So things like minimum wages, etc., are important standards that I think that the unions manage for us. I think that if you look on the African continent, there aren't big labor unions in most of those countries, and I think the challenges in the African continent is not importing labor; it's growing your own timber, and it's only if you grow a talent pool in countries are you able to reap the benefits of socio-economic development and the infrastructure funds that come through. The more foreign labor we import, we know that when foreign labor come in, they also leave. And with that goes the skills, and all you have is
But what happened to the skills transfer? This was all the rhetoric we hear when the politicians are standing at the podium, that with this big deal that this foreign multinational is coming with, they're going to be training X amount of South Africans as well. Are you saying that this is not happening?
Skills transfer happens, but it needs to happen at all levels in the organization, and it needs to be a deliberate program that you put in place where the people that you leave behind are sufficiently equipped to run an organization. And I think it becomes difficult for organizations, especially in the private sector, to create these structured programs of skills transfer.
Richard, I want to bring you in because Richard's been, agreeing with you all the way. But before I do that, Fungai, my idea of the bilateral agreements was tossed out the window. My idea of bringing in the foreign skills was tossed out the window. Let's get your take in terms of, from a policy point of view, what do you think is the most beneficial or effective strategy that if we were to make this a policy priority, to really beef up the human capital amongst the young people in terms of skilling them? What should we be doing at this point?
So I'll give an anecdote which maybe helps to answer that question. If you look at the Western world, notably the US and the UK and other parts of Europe, in the 80s, the 90s, and coming into the 2000s, they had a very big surge in the development of their financial services sectors. So much so that they had to actually import untrained people. A lot of people from all over the world flocked into those countries to work in those banks, those financial institutions. And then as and when they came of age or they felt like they could do better, what happened is quite a lot of those people chose to go back home So when you go across the continent right now, if you look at Egypt, for example, if you look at Nigeria, the leading local banks are actually run by people who honed their skills in different markets, got to a stage where they were happy about it and moved back home and then imparted those skills back home. And
where's the African diaspora, Richard? Where are the Africans who have been studying in the Ivy League universities abroad? Let's get a response to that, but also maybe to add to some of Mogam's comments around the fact that we're actually not seeing the transfer of skills at the desired pace and rate that we want.
Skills transfer costs a lot of money. Anybody who's done it knows that, especially in a time-based economy like most of us run, where your output is time-related, that means that you're going to double up on resources, double up on costs. Your bottom line is severely affected. So I think skills transfer on the job is the right way to go. I think trying to any training system, any education system reaches a certain ceiling, after which you reach saturation of what you can learn in the classroom, and it has to be on the job. What we need to do as a country and as countries in Africa is recognize that. And I mean, my call is for government and public sector to dialogue more on what are the systemic things that we need to do to encourage on-the-job training and skills transfer. Bringing people in from abroad, it's a reverse brain drain almost that happens. Is they come in, they do their job, they're obviously coming in for financial remuneration, and one of the risks of external assistance is such people are often seen as the saviors. Yeah. And so I've heard countless examples of external experts coming in, getting the processes going, getting things started, and then leaving, and the house of cards falling down, because the amount of skills transfer and the depth of understanding isn't possible in a short term.
As we come to the end of the show, I'd like us to just go around the table and get a sense of that one notable intervention that you think is going to be critical in unlocking Africa's growth potential. Let's start off with you, Mogam.
I think if we believe in the Africa vision, and if we know that the growth in Africa is likely to be irreversible growth and sustainable growth, and it's going to affect broadly the most of sub-Saharan Africa, I think the deliberate intervention that we need to put in place is around skills development. I think we've known from an organizational point of view, investing ahead of the curve is really important, so that you can take advantage and you are able to provide continuity from an investment point of view.
Fungai, the one critical intervention that you think should be a policy priority?
Let there be light. For me, it's really about electricity. Anything that can be done to improve supply of electricity, distribution of electricity, reduce the cost of electricity, I think everything else falls into place on the back of that. Because even these skills that you're trying to develop, it's quite hard to do that in the dark. The businesses that you're trying to get to move to the next level, where they have a lot of money to spend on development, it's quite hard for them to do that without electricity.
Let there be light, but let's just take a quick leaf from what we heard from Bismarck earlier on. Should we be privatizing? Should we be just revisiting policies? How do we ensure that we keep the lights on?
There's no shortage of models that have worked successfully on the continent in quite a number of countries, right? Kenya, as I mentioned before, have got a successful IPP program that is actually in place. If you look at Zambia, they're making great strides in improving electricity supply led by government. So I think there are a lot of examples for many of the countries to learn from. It's really about having that open mind. And I think, as Bismarck mentioned as well, it's really about taking care of those vested interests to allow for that progress to take place.
Richard, your single most critical intervention?
I'm going to take the utopian stance because that's my style. To me, it's about really embracing the idea of Africa Inc. and having role players come together with a proactive, productive, well-meaning approach. If everybody wins, everybody wins. It's quite simple. And I think that there's a lot of scope to do that in my industry, in the construction industry, better collaboration and long-sightedness from government to the construction sector, and understanding how to arrange things above board and within the regulations to make sure that we can deliver the dreams of the people.
To make sure that we can deliver on the dreams of the people, I think that should be certainly be our closing line. My key takeaways from this conversation: let there be light, invest ahead of the curve, and don't forget to invest in Africa Incorporated. And that brings us to the end of the special studio discussion. Thank you to my guests, Mogam Pillay, Chief Financial Officer for Africa at Old Mutual, Fungai Tarirah, Chief Investment Officer at Rudiarius Capital Management, and Richard Matchett, Divisional Director at WSP Civil and Structural Engineers Africa. Until next time, it's goodbye, and thank you for joining us.